We think we're on the cusp of that breakout. Gold has led the way. The others are right at the gate by our measurements. The gold market, in effect, is saying, okay, I'm through with my congestion phase. I'm now back resuming the uptrend.
This week's specials with Miles Franklin Precious Metal Investments. 100 ounce and kilo silver bars for only $269 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today, one of our viewers' favorite guests, Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Thanks, Elijah. Glad to be here.
It's great to have you. Now, the first topic I'd like to discuss today is gold and silver, because last week we saw quite a run up in both the gold and silver prices. However, you look at the momentum, which is different from just looking at the prices. So that's why we really wanted to have you on, is what is the momentum in both gold and silver showing right now?
Well, we have certain momentum charts we look at, and what we're referencing is a fairly long-term one. It's called quarterly momentum. But what do we mean by that? Is we measure week-to-week price in relationship to how much above or below the three-quarter moving average. Well, the three-quarter moving average, it changes at the end of each quarter. You average up the prior three quarters, the highs and lows, you get an average. It's sort of like a 200-day. That changes daily. The three-quarter changes only once a quarter. So it's like a big gear wheel, okay? Anyway, there was a structure. When you look at a momentum chart of gold, not the price chart, there was this flat structure that went all the way back to March of last year. There's a pivotal level. Either it was support or all this year it's been resistance. You haven't been able to get above it. We got above it last week by getting above 1825. So gold closed 1868, I think. So it had a good breakout on gold. So it shifted that metric, that long-term technical metric, back to positive after this, 16 months now of laborious congestion and pullback, which at its worst was only a 20% drop from the high, by the way. Now, with last Friday's close on gold, another thing happened, interesting, it's just a news point. Back in mid-June, if everybody will remember, the Fed had minutes released, and that's when they started using the word taper. And everybody went into a headline panic, pulled in their hair out, and they dumped gold. And like literally within a couple hours that afternoon, and for the next day, gold dropped, $150 or so, dropped very sharply. And but the point at which it was trading just prior to the release of those minutes was around 1860. Okay, so anybody who sold that news, and they sold it a couple times in the months since, where it would come out again, another story about taper and taper. They'd sell it and sell it and sell it. It was all redundant selling, the same level. It keep bouncing back. Finally, you're now back above that level. So anybody who sold that news is a loser. Okay. Okay. Anyway, gold broke out last week. Silver did not. We had a number on silver that the weekly settlement price on Friday, the closing price, which is at 1:30 Eastern time, by the way, it keeps trading all the way up to 5. But at 1:30 Eastern is when they officially settled silver. It closed at $25.34.6. Okay, $25.34.6. Okay, about a penny and a half below a level we defined as a breakout weekly close. So it didn't break out. It's right at the gate trying to break out. So today we're pulling back a bit. If you can close a week out in silver anytime this quarter at 25.36 or higher, it's our assessment that it's joined gold. It's broken through its quarterly momentum hurdle. Okay. We're also watching the miners, the ETFs, the gold miners, silver miners, and so forth. And actually, the silver miner ETF broke out last week too, along with gold. The other mining ETFs did not. They're close. They're at the gate, as we call it, but they've not fully broken out yet. So we think we're on the cusp of that breakout. Gold has led the way. The others are right at the gate by our measurements. And these are not levels that the price chart watchers think are significant, but for us, they're very significant. So we think that the shift is now underway, and the gold market, in effect, is saying, okay, I'm through with my congestion phase. I'm now back resuming the uptrend. And we expect to see that. And when we see silver break through its hurdle, I suspect you're going to get some volatility. in the next several weeks following that, where the rise in silver and gold gets a little more obvious and dramatic, such as, for example, silver rushing back up to its old price highs. And as you know, if you go back and look to last August, there's a whole set of weekly closes at around $28, peak closes, and there's intra-week highs that reached up to 30 a couple times. So that's what we're talking about. So you can rush from this 25 level back up to the top end of that zone, and we think you could do it pretty quickly if we can get our weekly closing breakout that we're looking for, and we think we'll get it. Anyway, so that's the status of those key markets.
For those people looking to invest again in precious metals, we've seen this last week, gold and silver rise quite a bit. Are you looking at all for a pullback?
I'm looking for a sharp pullback here. I think after the breakout, you could congest maybe, because after all, silver is at the gate, as we said, it's at the structure that if you can close above, so it's an important level for momentum. And sure enough, the market is acknowledging that in the way that it behaved Friday. It was above our number, but then it came back and settled penny and a half below. So it's as if the market knew in its guts, okay, this is where the line is. And so you might see some congestion and some distribution there or whatever, but I don't think you're going to get a meaningful pullback from these levels. I think you might get a pause for several days or something. But again, we're watching that number on silver. When we see that green light turn on, that's it. As far as we're concerned, the complex is going up. But there's other interesting markets that are investors should watch. The stock market, we think it's in a topping process. No, it's not obvious because it feels like, every day you make a new high and a crawling rate. But there's a lot of things going on technically based on our momentum analysis that suggests now you're probably in a topping process. And it won't take but several percent drop in the key indexes for us to say, okay, we know we're in a topping process. We're not looking for a crash event, but we think probably the more important market to watch in terms of the issue of the central banks. And remember, while the Fed is talking taper and there's a lot of political pressure on them now to do something about inflation, the ECB is not. They're not softening at all, or hardening rather. They're still easy money, and the BOJ is thinking about going even more aggressive into the money printing again. Japan has not been doing very well, GDP-wise. So the issue for the Fed is it's an intellectual problem that it's a contradiction of the nature of what they do, because all their notions are wrong anyway. You don't, at the point of a gun, in effect, set the price of money. Money is a commodity. Like any asset, it has a value, different value for you or me or somebody else, a different situation. But the net result is free pricing of money, where it fluctuates based on overall demand and supply. They want to come in and say, no, we're telling you what the price of money is, no interest rates. And in so doing, they've created exceptionally low interest rates for a dozen years now. In fact, go to the St. Louis Fed website and look up Fed funds rate. And you'll see a chart of the Fed's funds rate, which is so ridiculous that you see over the past 20, 30 years, nice big rises and falls in the Fed funds rate. But then in 2009 and 10, it went down to zero. Effectively, just laying there, a little hump up one in the middle of that and back down again. But when you look at that chart, you say, no wonder the stock market has gone berserk. Money's free. And the Fed's fund rate chart is it's the most ludicrous thing you've ever seen. And so the Fed has created a monster, a high-priced stock market that's valued based on the degradation of the money unit, not so much on the real world, okay? We think asset managers and investors are beginning to shift their money out of that category because they perceive risk or lack of reward going forward, and they're moving it into other areas, especially gold and silver, and commodity stocks in general, for example, which have done quite well. Fertilizer companies, you name it. If it's ag-related, it's gone up big, or copper-related and so forth. But there's one arena that the Fed will be very attentive to. It's both the muni bonds, local government, city government, state government bonds, which collapsed back in 2020, along with the stock market. Well, the Fed came in and bought those things in the open market. But then they also came in, started in May of last year, a couple months off the low in the markets, started buying high yield corporate debt. including the ETFs of high yield corporate debt, like HYG and JNK, junk ETF. These are corporate bonds that are high yield, meaning they're high risk corporate bonds. What's been going on technically over the last couple of years is if you look at the charts of those two ETFs, they tend to move up and down with the stock market. They almost look like the S&P 500. The only difference was in the rally that we had in 2020 that put the S&P into new highs, they came back up and basically halted around their old highs and stalled. They stayed firm, but the Fed was the primary buyer of these, outright buyer of the ETF, something the Bank of Japan's done for years. It's a majority owner of a lot of the assets in Japan. But they quit buying in June, Fed did. The best I can tell from the reports I've seen. They ceased buying. And I don't know whether they've started to divest themselves of this, but if you look at the charts of HYG and JNK, they've been coming down for the last few months and divorcing themselves from the S&P. Now, this is extremely critical because this market, if it fractures itself and starts down again, it's extremely important to the Fed and means that they can't tighten. Because if they tighten, in effect, they're going to kill this market again. They have to be accommodative. So watch that market if it starts to break. And we are literally about 1 point above on these ETFs, above levels that we determined at MSA, that they're turning down. And so I think if these two ETFs, junk and HYG, do break their structural supports on momentum, they're headed south again. And that's going to be panic time again inside the private door inside the Fed meetings. They're going to be concerned again about these debt instruments because it has huge wave effects on things like employment or unemployment, businesses in general, and affects individuals. Therefore, it's a wave effect. So if those markets start to turn down, pay attention, because that's going to put a lot of pressure on the central bank here to not do what is being demanded that they do, namely taper. So it's going to be an interesting dilemma for them.
No, we have been hearing some rumors that Brainerd might be the new Fed chair. It seemed like there was an interview with Biden on that. Your perspective on that, what that might mean for Fed policy, because we just saw the Fed taper. But if Brainerd gets in there, she's the progressives pick, right? And seems to be more hawkish than Powell. So your perspective on that?
Well, she will definitely philosophically be more in line with continuing to print and to subsidize asset classes like we're talking about the high yield debt and so forth. But she's got a political problem because there's a lot of Republicans who won't vote for it. It's a question as whether she could get the approval and so forth. But, Biden maybe wants to placate the progressives. Think about it, because, in effect, they didn't get what they wanted in the recent bill. They got the infrastructure, but they didn't get the other one that they wanted. And they were supposed to get that, right? And then they had they compromised on that. They allowed, okay, we'll let you have your other one. Despite Joe Manchin, they got at least that much. But the progressives weren't happy with that. So he can throw them a bone because they want her, Lael Brainerd, rather than Powell. So the question is, he's already delayed way past the point normally where presidents say, okay, it's my new nominee. Normally it's early November. Well, now we're getting into mid and late November. He hasn't told us who it's going to be. So he's obviously having a lot of internal discussions to maybe placate the progressives. I don't know. Now, the question is, will it really net on balance change the ultimate outcome of what the Fed does? And I really don't know I could say that. Yeah, she's more, quote, progressive than Powell might be. But Powell's proven that, if he needs to print, he'll print. And he has no real alternative other than to turn his back and say, okay, all these markets that we've supported over the years with artificial pricing of money and sometimes outright buying of the instruments, we're going to turn our back on it and just listen to what happens. Will he really do that? That's a question because whether he's not left as she is or not, he's still demonstrated that he's willing to do what is needed. At least from his perspective. So I don't know in the long run whether it really makes a big difference.
We did just see the Fed taper. Do you expect them to continue to do this? Because we have seen inflation now rise to 6.2%.
Well, they might, but then again, you've got to watch. I suspect what will happen is if they do that, if they go into a more tighter course, a less money printing course. They're not, for instance, continuing to buy those ETFs I mentioned or muni bonds. They've ceased that, and those markets are starting to come down. So maybe they have to come back in again. But it's a predicament they're in. I don't know whether they continue, but if they continue on a taper course or a non-subsidy course, changing their policy back to a more neutral status, let's say, and these markets start to break down, it may get to the point where they break down too much, and then the Fed literally has to come in because it's panic time again in those markets. They don't anticipate the event, the downturn, like momentum structural analysis is doing. They won't act early, they'll act late, but by the time they act too late to remedy the situation by going back to their prior policy, those markets already be in disrepair and already have created wave effects in the real world. So I suspect if they're going to cease the taper and go back to their policy of the last year or so and buying assets like that in the open market, that they'll be acting too late. They will have caused damage to occur, and then they'll panic and come in again. But it may be too late at that point, where those assets, where people are liquidating those assets and running to other safer areas, such as the markets we were talking about, gold and silver. So it's going to be, they're in an interesting predicament, and I don't think there's any way out for them. If they do taper and try to cut inflation, they're going to create damage in these markets that will panic a lot of people, including them. So 6 of one, half dozen of the other, the outcome's almost the same. You're going to have to revert back to monetary expansion, full blast, to defend against the collapse of these artificially priced markets.
And on one side, they have to defend against the collapse of the markets, but on the other hand, you have the collapse of the dollar that we're seeing as we see inflation very high right now. So do you see just inflation to continue and not be transitory?
Well, I don't think it's transitory because I think it's primarily monetary. And I think the monetary policy, like I've been arguing, if they try to get off track and go back to a less loose approach, the markets are going to force their hand to come back in again, except maybe at a more dangerous level where the market's in question. Now, the stock market may be a laggard in this process on the downside, but you look at the corporate high yield market, and if it goes, it's major. It's not just the stock market they'll be concerned about. So those markets are literally dancing on the structures we're talking about to break on momentum. Similarly, like gold and silver had structures overhead that gold is now broken through, which might be a hint that the opposite's going to occur with those markets, the high yield debt markets. We're talking private debt, corporate debt, not U.S. government long bonds. And if that market goes down, the Fed's going to panic. And all these people who on either side of the street are saying, you got to tighten, including a lot of liberal economists are saying the Fed needs to get on course to tighten up a bit. They're going to think twice.
No, I asked viewers to submit questions, and one of them is from Lucas. He asks, Michael, why do you think the gold and silver breakout and move towards $200 for silver and $8,000 for gold will be fast instead of slow?
Because the macro technicals, and we've been talking fundamentals here too, but the macro technicals of other key markets fit with that scenario. In other words, they're in such an extreme position. Again, I suggest somebody either look at momentum, get an S&P 500 chart, go back to 2009 and look at that chart of the NASDAQ 100 and tell me that's real. And then look at the Fed funds rate chart. And you say, oh, now I understand. Okay, free money. Okay. And then look at the high yield corporate debt market as well and say, is that a normal event that we've seen over the last 5-10 years in that market, resurrected from the dead and priced off the page and now acting like it want to go? So we're in the type of world where when these events start to come undone, and I don't mean gold coming undone on the upside, but these other markets, high-priced, artificially priced markets, come undone and back to the downside, could be dramatic in percent terms. And so many businesses and governments have been dependent on this ongoing process of cheap money and everything being accommodative, that if you shut that off and reveal that what has occurred over the last dozen years is perhaps way too artificial, and it starts to come undone, it's going to come undone like a balloon, air coming out. And I don't think it'll be gradual. And the technicals tend to bear this out. They say, yep, those markets that have gone into upward curvature, when they turn down, they could go into a downward spiral rapidly. Especially, I'm looking at the high yield corporate debt again, and in muni bonds I would watch as well. That could be dramatic. And it's not something everybody's watching. Most people are watching the stock market in terms of, the fear factor. If the Fed tapers or the stock market might weaken, we've had some economists make that note that, yeah, we need to tighten, but that stock market will go down if you do that. Well, also watch the corporate debt market. So anyway, but the unwinding could be dramatic. Is what we see in all the momentum charts and the price charts, and not just a gradual downturn. In which case you'll have wave effects the opposite way in gold, because there's so few alternatives out there for investors to put their money in. And I know Bitcoin and so forth is viewed as one of those arenas, and it does have its virtues because it is a money unit that cannot be inflated beyond certain very micro amounts annually. You can't manipulate it, and it's not controlled by a government. So it's not a policy instrument. It's priced by market forces. And we know it's competing with gold, and there's been a big debate about, well, it's siphoned off a lot of the buying that might otherwise have gone into gold and silver. Well, in our reports recently, we've run some studies, technical studies, long-term momentum of the relationship between Bitcoin and gold, its spread relationship, its performance trend, in other words. Not looking at its price chart, but it's difference between Bitcoin and gold that creates what's called a spread chart, the difference between them. And it goes up and down just like a price chart does. And over the last 5-6 years in Bitcoin, since 2016 or so, there have been some big up moves in Bitcoin in price and in net performance versus gold, beating gold and silver. But when we analyze the momentum of these charts, we come up with an observation that suggests, don't be shocked that if by late this year, early next, that trend changes and it's measurable. You can't see it in the price chart of Bitcoin, but you could see it in the spread of Bitcoin versus gold and silver, that it wouldn't take much of a stall in Bitcoin and or a rise in silver and gold while Bitcoin stalls, let's say, to break that spread down, meaning turn cryptos into underperformers versus gold and silver again. So the 3,000-year-old metals become dominant again. It wouldn't surprise us. In fact, I technically tend to expect it. It hasn't shifted yet, but it's ripe to do so. So that would be an interesting event. That'll also narrow the focus of the alternatives somewhat, where money will say, hey, I'm not making as much money in Bitcoin as I used to. Now I think I'll go over to gold. It's looking pretty good. And so you could have a shift in that, which would also help boost gold and silver if that performance trend shifts.
Now, another viewer is wanting to know about retirement accounts, and I know we can't give personalized financial advice on this channel. Your perspective, though, on people who are in 401ks, for example, and probably heavily invested in stocks and bonds, how will they be affected in the times ahead? Well, just like any account would be. I mean, they can move into commodity-related and gold-related assets, including bullion ETFs, unleveraged gold, unleveraged silver in ETF form, or buy the mining stocks and begin to, shift some of those other glorious assets that have been priced well by the Federal Reserve for them, and begin to shift some of that over into other less vulnerable areas and likely more rewarding areas. And we argue that's basically going to be gold and silver at the forefront, especially silver on a percentage basis. Therefore, we tend to favor the silver miners over the gold miners, because we think silver on a percent basis will outperform gold in the coming year or so. And in the commodity arenas, there are many areas that are benefited by rising commodity prices that are, mining companies and like I said, fertilizer companies. In fact, we picked on fertilizer companies about 1.25 years ago and said, buy them. And basically the ones we picked have tripled. And now we see the reason why, of course. The ag prices have gone up, and also there's jeopardy to fertilizer because of natural gas pricing in Europe, for example, is off the page, and it's pretty high here too. That affects the profitability of companies that make fertilizer, because natural gas is part of the process of making phosphates into the fertilizers. And so, for instance, it was a few months ago, CF Industries, which was one of our picks, in the UK
basically shut down because they weren't getting money because of the gas prices, natural gas prices. And the UK government, as I understand, came in and paid them to reopen. And that has wave effects as well. What happens if we have a tight supply of fertilizer come planting time? The spring of next year, for example, or if those prices are real high, and et cetera, et cetera. And that could affect what? Quantity of food. So there's all kinds of big dominoes here in play. But in your retirement fund, just begin to consider what Ray Dalio has said. He's not even a gold bug until recently. He says money is trash, cash is trash. Get into more commodity-based things and begin to doubt the stock market. Get into more gold-related and so forth. And so that would be my broad suggestion.
One last question we have from a viewer is on platinum. You've talked about platinum before and how it's really a different animal than both gold and silver because it's not monetary. Are there any key price points that you're looking at currently for platinum?
No, it registered a breakout, as did most commodities. It was like a basket event. The unrelated commodities, platinum, corn, sugar. All late last year, August, September, October, we were putting out report after report saying commodities are going to explode. They're going to explode. Well, they did explode. And it wasn't because of a unique situation for each commodity, like, we had a drought, therefore it affected corn prices, or anything like that. It was a monetary event where the asset flow came into those markets, which were fairly tight. They'd been depressed for years. The commodity complex peaked in 2011, collapsed into 2015 like gold did. Remember, it made its low in late 2015. Gold then started to bottom and move up. But the commodity complex laid on its back at very low levels for 5 years until late 2020, basically. And most of them turned up then, platinum included. Now, platinum's had a sharp pullback since, as have many commodities. Copper had a good drop, corn and soybeans pulled back. And we think it's just a pullback in an uptrend. That's our assessment. It's not a top. But platinum's basically, we've said to treat it as you would most commodities. It's not special. And its sister metal, palladium, which of course is in cars, exhaust systems, is behaving totally different because it had already boomed big time. And now it looks very vulnerable to us in terms of having made a top probably. So it's not to be linked with the commodity complex, but platinum does look and behave much like most commodities. And we argue that in the next year or so, while gold and silver have for the last year cooled off and gone down while commodities went up, therefore underperformed commodities, that's going to shift again. And gold and silver will outrun commodities going forward. They're better positioned technically and fundamentally to outpace the commodity complex. So I think though platinum will perform as well as the commodity complex, it's not special.
All right. Well, Michael Oliver, we really appreciate your time today. Before we let you go, any last thoughts you'd like to leave with our viewers, and where can our viewers find you online?
Well, it's olivermsa.com, MSA for Momentum Structural Analysis. We've got some pages there that explain our methodology. Please request some sample reports. You'll see some reports on that site. And, we have various products. We offer a Bitcoin report every 2 weeks. It includes Ethereum. We have a gold, silver, and mining report that comes out once a week, if not a little more often. We have our major report, which covers all asset categories. And it's higher priced, but it does cover all the major asset categories: the debt market, foreign exchange, commodities, and stocks. And you really have to, we argue, you need to be looking at those other asset categories, even if you're not in them, because what they do is going to have a great impact on what the Fed does or doesn't do, and what gold and silver do, and how fast they do it.
All right. And I realized just one kind of fun question from a viewer here. Please tell us about the steam engine picture behind you.
Oh, that's just that's a train. I was in North Carolina at the time. Those are my two sons. That's about 25 years ago. And it was a beautiful train. It was an antique type train. And we went over to visit, and I took their picture. And it's my favorite family picture there. Anyway, my older son edits our reports, Lauren Oliver, and my younger son, Brett, is a co-producer of me with the reports. He's an analyst as well. And so it's basically a family business. And also my daughter-in-law works in the back office, so to speak, keeps things running. So it's a momentum structural analysis, been around for it's now since 1992, so we're talking 30 years. Anyway, we provide good research, and usually we're right. Don't want to brag, but our methodology, we think, is pretty sound.
All right. Well, Michael, thank you so much for that, and thank you so much for your time, and God bless.
Thank you.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.